but she's been mentioned as a possible Secretary of the Department of the Interior. In Chicago, hundreds of workers at O'Hare International Airport are delaying their strike until after the Thanksgiving holiday. They say they want the public support and don't want to mess up anyone's holiday plans. The group, including baggage handlers, cabin cleaners, and janitors, plans to hit the picket lines November 29th. They want union rights and a $15 hourly wage. A growing number of Haitians whose country is struggling with poverty and the aftermath of a hurricane in October are leaving the country, but they're not headed for the United States. They're going to Chile. Authorities there say more than 34,000 Haitians arrived in the first 9 months of the year. That means South America's wealthiest nation is now taking in immigrants at a similar pace to the UK relative to their populations. Pope Francis is allowing all priests to absolve the faithful of what they call the grave sin of abortion. The pontiff is extending indefinitely the special permission he granted during the just-ended Holy Year of Mercy. Vatican officials describe the announcement as an extension of the Church's mercy. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
From the close of trading here in the U.S., live from Bloomberg's World Headquarters in New York, I'm Scarlett Foe.
And I'm Joe Weisenthal.
U.S. stocks on the rise today, pushing the S&P 500 and others all-time highs, while oil jumped on optimism that OPEC will agree to cut output.
The question is, what'd you miss?
President-elect Donald Trump is on the hunt for the next Treasury Secretary, and his meeting suggests he's looking for a candidate with deep Wall Street experience. We'll take a closer look at the top contenders. All eyes are on Europe, where the rising populist mood is dominating the moves in the FX and debt markets. Will Italy or France be the next shoe to drop? Meanwhile, Brexit remains top of mind as Prime Minister Theresa May begins to lay out her plans to leave the European Union. We'll hear from opposition Labour Party leader Jeremy Corbyn later this hour. But let's kick things off with the major indexes in equities and the fact that they're all at record highs as we head towards a close. Bloomberg's Abigail Doolittle is standing by. Abigail?
Pretty amazing on that fact, Scarlett. But the funny thing here is that we're almost looking at quietly bullish trading. Quiet because there's not a lot of exuberance to today's trading action, but very bullish because we do have the three major averages of the Dow, S&P 500, and NASDAQ all trading at record highs, both on an intraday basis and on a closing basis, on pace for a closing record high concurrently, the first time that's happened since August 15th. As for what's working today, the top performing sector, we're looking at energy being boosted by Marathon Petroleum, Southwestern Energy, along with Chesapeake Energy. And of course, behind all of this, we have a nice rally in oil. Oil is up for a second day in a row. Today up nearly 4% as OPEC, as you had mentioned, is saying that they're close to working on a supply cut deal. As for the top performer here, though, Marathon Petroleum, we also have a separate situation outside of oil, and that is the fact that Paulson's Elliott Management has urged Marathon Petroleum to split into three different businesses, that by doing so they could unlock up to $19 billion that this company right now, after its spin out from Marathon Oil back in 2011, is, quote, severely undervalued. As for the macro driver that behind all this energy strength, oil, let's take a look at a chart of oil. That is #BTV 5087. This is a 3-year chart of oil, and this year we see that oil has, for 3 times now, gone back above the 200-day moving average, bounced above it. Typically, this is bullish. It tells us that the buyers are really in control. The last 2 times this has happened, it's led to some pretty decent near-term upside potential. Perhaps this happens again. Plus, we have what appears to be perhaps some sort of bottoming action for perhaps even some bullish action over the medium to long term. So this chart of oil appears to be fairly bullish at this time, Joe and Scarlett.
All right, lots of bullish signs then. Abigail Doolittle, thank you so much.
What'd you miss? Some have described the sell-off in the U.S. bond market as a bloodbath and a seismic shift. Our next guest says rising Treasury yields can be attributed entirely to inflation expectations. Joining us now is Ira Jersey, Oppenheimer Fund, Senior Client Portfolio Manager and Fixed Income Strategist. Ira, thank you very much for joining us. Certainly the defining characteristic of the post-election market landscape has been this Treasury sell-off, rates higher pretty much everywhere. What's the connection between the election and this move?
Well, basically, it's the idea that the missing piece from the recovery has not been low rates. Monetary policy has run its course. It's done everything they can. Now the seed change to the populist movement, maybe not so much in the UK, but here in the U.S., is that we might actually get some fiscal stimulus, which could drive both growth and inflation higher. Have the markets, I get asked this all the time, have they gone too far? Are we properly pricing? I think somewhere around 2%, 10-year, what we call inflation break-even. So what the TIPS market's pricing for inflation is probably about right, and we're pretty darn close to that. So we might be toward the top of at least the near-term yield range for 10-year treasuries.
And of course, we're not just looking at what's happening in the U.S. This is happening around the globe, and bond yields do tend to move together. It's a global phenomenon. Even if we have reason to push yields higher in the U.S., are those same reasons justified elsewhere in the world?
Well, in some cases. So in places like Europe, perhaps it is, because one of the things about Europe is that very stable growth. Inflation is going to probably be modestly higher than what expectations were 6 months ago. But that doesn't mean it's going to necessarily be high. But should you have negative 10-year rates in Germany? And the answer is probably not. In Japan, it's a different story, right? Because there you have a central bank that's saying, hey, if yields get too high, much above zero, we're going to buy every bond in sight.
Or at least they threaten to do so.
Well, they threaten to do so, but they haven't had a need to yet, right? At 2 basis points where it is today, that's not meaningfully enough away from zero for them to act. But if that threat is actually realized and they do come in and buy several hundred billion yen worth of bonds, then I think you can see that stay more towards zero. But you're right. In developed markets in particular, you can wind up having rising bond yields in a lot of the developed world. The emerging world, much more idiosyncratic. That's really more country by country.
So it's fairly clear, okay, we get this fiscal stimulus in theory, and then we get higher rates, higher inflation expectations. Let's talk about some of the second-order effects. What does the Fed do? How does this change their timetable? And also, how does this hurt the real economy? Higher rates have a negative effect on mortgages, financial conditions tighten. So what happens after this first effect that we see in the rates market?
Yeah, so I think those are two very interrelated questions, because the Federal Reserve, if higher yields, if we get, say, another 25 or 50 basis point backup in 10-year yields and you get somewhere close to 3%, you could see a significant slowdown in the housing market and in maybe purchases of some things that tend to be interest rate sensitive, so automobiles, for example. If that were to happen, then you'd wind up seeing the Federal Reserve maybe even take a more cautious and dovish stance, being more reluctant to actually hike. However, if everything stays along in the steady state that it is, even with bond yields 100 basis points, 1% higher than they were a few months before, then the Federal Reserve would likely continue to hike, and maybe at a slightly faster pace. But the problem is that we have a lot of uncertainty. The market is pricing in a lot of good news right now, and we really don't know. We don't know exactly what any infrastructure spending out of Washington will look like. We don't know if it will actually be inflationary, because there's other factors globally and domestically that are impacting inflation. So at some point the market's going to find an equilibrium, trade in a range, I think, and then we'll wait for the actual news to be realized or not and reprice further. So
savers and pensioners shouldn't be too early in celebrating just yet, because as those yields rise, they finally are starting to get some income. I mean, we've seen the income generated from treasuries plunge over the last 3 decades. It's been a slippery slope down, as you can see in this chart. If we can keep these bond prices down and these yields higher, you might start to see a bit of a turnaround there. Yeah, you could. And certainly if you wind up having some additional fiscal stimulus, which means higher deficits, you'll even have more bonds in the market. More volume. Right. You have more volume to do that. One of the things that this has helped is, and there was a story on Bloomberg today about this, is how it's helped insurers, because a lot of asset liability managers, insurers, some pensions, who need bond yields at corporate bond yields at 4.5% or 5%, you can find some of those now in investment-grade bonds. And that's one reason why it's kind of been tricky for the 30-year yield to get above 3%. Hard to imagine. I mean, if you had asked me in 2007, would we ever see 3% 30-year yields, I'd say no way, much less 2.25% where we were not so long ago. But this backup in yields does help a lot of those type of managers.
People have been asking for fiscal stimulus for a long time, saying it can't just be monetary policy. We really could use some more deficit spending to boost the economy. However, now we're at 4.9% unemployment. By some measures, wage growth, the Atlanta Fed measure up to 3.9%. if there is a big, say, infrastructure deficit-led stimulus, and it ends up, say, competing with other industries in the private sector for labor, construction obviously comes to mind, housing comes to mind, does that actually help the economy, or does that just have an effect of boosting prices without actually adding more aggregate demand?
It's a good question, and I defer to an economist who studied this a little bit more than a rates strategist like myself. But I do think that your point's well taken in that are you going to push wages almost too high, and will you wind up getting a price push on inflation? The answer is probably not, just because if even what Stanley Fischer said this morning in his speech here in New York, one of the things that he noted was that the quality of jobs isn't there. So, there is an issue where if you wind up with infrastructure spending and you wind up with more construction jobs overall, assuming they're in places where unemployment's still relatively high and underemployment is still relatively high, then that would help everyone and certainly help those people.
So there are places where there's still slack, even if the aggregate number is not appears close to full employment.
That's right, because monetary policy can't help that, right? That's why fiscal policy has to somehow.
So there are a lot of post-election narratives swirling around right now. Most of them are pretty straightforward, even as we don't know a lot of the details. Which narratives don't make sense and therefore provide opportunity for an investor?
Well, one is, I think, the idea that you can wind up with trend bond yields that wind up at very high, so-called very high, say normal, right? What we would have called normal prior to 2007. So something like 6% 10-year bond yields, I think, are very unlikely. The situation where you can get there is where the Federal Reserve actually makes some changes to their balance sheet and they wind up selling a lot, and that's really probably the only realistic way that you get up to those kind of yields.
Out of curiosity, something I was thinking about. So bond strategists tend to be famously bearish on bonds, and every year their rate forecasts are usually too high, or the consensus, and then the rates fall below their expectations. Could we get into another situation where bond strategists, we've just become so used to the bull market that we don't see a bear market when it comes?
Yeah, that's completely possible. I mean, everyone's been talking about the death of the 40-year bond rally for a long time, and everyone, forecasting for it. I think one of the issues, even though, one of the inputs to where yields are going to go is going to be where the real economy goes. So and forecasting that sometimes is very tricky because you have exogenous shocks. So you have the European crisis in 2011. You wind up having the taper tantrum in 2013. You wind up having a lot of different issues that crop up and wind up making your economic forecasts incorrect. So therefore your yield forecasts are incorrect. But yes, that is a distinct possibility that we could be too pessimistic about the health of the economy.
All right, Ira Jersey, Oppenheimer Fund Senior Client Portfolio Manager and Fixed Income Strategist. Thank you very much.
Thank you.
Coming up on What You Missed, British Prime Minister Theresa May says the UK will leave the EU by March 2019. We'll have more on the transition with UK Labour Party leader Jeremy Corbyn. This is Bloomberg.
What'd you miss? Today, Bloomberg sat down in London with UK Labour Party leader Jeremy Corbyn and discussed all things Brexit, as well as Donald Trump. And listen now, Bloomberg's Neera Chehich started in the negotiations and whether state intervention is something that's good for business.
I think state intervention alongside private capital can be very good. I mean, if you look at the history of the industrial developments in Italy and in Germany, where there's been a very substantial state role played, I think there is a very important role for that. Undermining the steel industry by non-intervention is a bad thing. Supporting the steel industry by a degree of state support and intervention surely is a good thing, because it provides the platform for our manufacturing industry to develop.
Prime Minister Theresa May earlier acknowledged calls from the CBI here to avoid a Brexit cliff edge scenario. What would you say in her shoes?
What I would say is, first of all, make it very clear we intend to make sure there is market access for British companies to have trade with Europe, and that the rights that have been gained through European membership will be defended and continued, and that we intend to work with Europe in the future. The idea of what I suppose would be called a hard Brexit, where you end up with a tariff war between Britain and Europe, where much more than half our trade is with Europe, would be very, very damaging indeed.
Is Britain headed for a hard Brexit, though, in your opinion, and have businesses expressed concerns to you about this?
The latter, certainly. I've had plenty of concerns expressed. Every business I've met, every trade union I've met, every group of residents and workers I've met are concerned about it. Are we heading for it or not? The problem is the government will not set out what its negotiating path is, will not set out a proper timetable for it. All they've come up with so far is the highly original words that Brexit means Brexit. I don't know what Brexit means in that context.
Would you support the UK leaving the customs union?
I think we'll have to negotiate on that. The issue is also about questions of the power of national governments to invest in their own industries, and also, of course, the power of a national government to take industries such as rail companies into public ownership. We don't wish to join an organisation that restricts us from doing that. I wish us to be able to trade with the rest of the world, but also have a human rights and environmentally sustainable agenda on trade policies as well, and I'm not convinced that that would be possible.
I'm wondering how concerned you are by François Fillon winning the first round of the Republican primary in France. Do you think it's a failure of the left that voters seem to be voting in more right-wing candidates, both in Europe and the US?
There's been a fundamental change in politics. The politics of the left and centre-left have changed a lot over the past 10 years. The parties of the left that supported austerity in 2008-9, and then in the case of, for example, PASOK in Greece, implemented very severe forms of austerity, ended up losing out quite badly. As in the United States, what's interesting is the anger of working class communities at the lack of investment, the lack of jobs, the lack of opportunities, and the underinvestment in housing and health services plays out two ways. They can either blame minorities, as with Trump, as is Marine Le Pen, as is the right all across Europe, or they can look to the community solutions that the left are offering, such as the huge support that Bernie Sanders achieved in the United States and the enormous increase in Labour Party membership in this country.
Now, the UK's considering, on this subject of recent elections, is considering inviting President-elect Donald Trump to visit Britain on an official state visit. Have you asked to meet the President-elect, or will you?
I will meet the President-elect, and I will make it very clear that I absolutely and totally deplore the comments he made during his presidential campaign in respect of women, in respect of minorities, and the way in which he sought to blame very hard-working Mexicans throughout the whole country, very hard-working Muslims throughout the whole country, for any economic ills anybody suffers. And also the idea that you can run an economy on the basis of a race to the bottom in taxation and the grotesque levels of inequality that will bring about is simply not a way forward. But I want to live in a world where we don't all go to war. I want to live in a world where we're dedicated to sustaining our environment and, above all, sustaining our economies so that we don't have these appalling left-behind communities, as you find over the Great Lakes region of the United States, as you find in many parts of Europe, and indeed as you find in parts of their own country.
That was UK Labour Party leader Jeremy Corbyn.
It's time for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. Amazon is considering offering a premium sports package with Prime membership. That's according to a report in the Wall Street Journal. The e-commerce giant has reportedly been in talks with the National Basketball Association, Major League Baseball, and National Football League. Amazon has even reached out to Univision about Mexican soccer league games that it has rights to but currently does not air. Anbang Insurance is close to buying residential property assets in Japan from Blackstone. Its first foray in the country since a failed bid for an asset manager last year. That is according to people with knowledge of the matter. A deal could be signed as early as this week for the assets worth about $2.3 billion. Walmart is kicking off Cyber Monday on Black Friday. Cyber Monday, which falls on the Monday after Thanksgiving, is typically the busiest day of the year for online shopping. Now, the discount chain says it'll have 23 million items on sale online. That's compared with 8 million last year. And Kanye West is missing out on about $30 million in potential ticket sales after abruptly canceling the remaining dates of his St. Pablo tour. According to Live Nation, West had 21 dates left on his tour. The hip-hop superstar had been taking in more than $1.4 million a night off of ticket sales alone, meaning he's leaving about $30.2 million on the table. And that is your Business Flash update.
Up next, hedge fund billionaire John Paulson went long on Donald Trump when most of Wall Street went short. And look at how his contrary bet is paying off. This is Bloomberg.
I'm Scarlett Fu. What'd you miss? Trump's election victory is pushing shares of Fannie Mae and Freddie Mac way higher. Take a look at that move over the last 2 weeks. It is parabolic. And, of course, do you remember Fannie Mae and Freddie Mac? They're the mortgage financing agencies that at one point were private companies with implicit government backing before the government took them over in 2008. And John Paulson has been making big bets on these two. They're both agencies. They've seen their common class shares more than double in value since the election. Now, Donald Trump hasn't really articulated any specific plan when it comes to these government-sponsored agencies or enterprises, but investors are betting that he will potentially make it so that, or change rules so that their profits go back to shareholders and not just to the Treasury. So this is something that we're keeping a close eye on, certainly something that John Paulson is benefiting from in the meantime as the share prices surge. There is a Bloomberg News story by Joe Light today that takes a look at how John Paulson over the years has been putting money into lobbying the government over a change in policy, both directly and indirectly, so that the companies, again, and the shareholders can benefit from the return in profitability to their bottom line.
Right, they're in this weird limbo state where they're still publicly traded, but all the profits get remitted to pay back the bailout. But if there could be a legal change and the courts rule that the shareholders were to get the money, those shares could be worth a lot more. So.
Right now, it's just a paper gain until he sells
Exactly right. All right, I'm, metals, mining, emerging markets, they all usually move together for obvious reasons, but there's a divergence. JP Morgan flagged this chart. The blue line here is the all-country metals and mining index, whereas the white line is the emerging markets. Metals and mining have held up very well, but emerging markets have gotten clobbered after years of these two lines going together. So you can see there's kind of this divergence now. People liking the metals and miners on this idea that there's going to be a big infrastructure boom. Potentially that's going to need a lot of metals and raw material. But they're not liking the emerging markets because of worries about higher rates and a trade war. So creating an interesting divergence. And potentially, if you think that that divergence can't last, theoretically an opportunity for traders to bet on those two lines converging again.
I wonder how many of the metal and mining companies have U.S. dollar-denominated debt.
That's another interesting.
That would be a big issue.
Yeah, we should figure that out.
We should look into that. All right, the market close is next. Take a look at the major indexes. With less than 4 minutes to go before the close, you've got record highs for the Dow Jones Industrial Average, record highs for the S&P 500, all-time highs for the Nasdaq, and on top of that, the small cap Russell 2000.
Green everywhere.
Green everywhere. This is Bloomberg. We're moments away from the closing bell. What'd you miss? The S&P 500, Dow Jones Industrial Average, Nasdaq Composite, and Russell 2000 all climbing towards record highs today. And, of course, the small caps, as we mentioned, higher for a 12th straight day since the Donald Trump election victory. I'm Scarlett Fu.
And I'm Joe Weisenthal. I want to welcome our viewers who are turning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
When it comes to superlatives, the thing that you need to mention when we begin our market minutes is record highs for all 4 major indexes.
Green everywhere. Amazing. Record highs across the board.
Record highs across the board. And, of course, if you go inside and take a look at the different sectors, what's interesting is that it's only 10 out of 11 sector groups that are higher. Real estate has now turned negative, so it is closing off the best levels of the session. But the big winners here were certainly some of the ones that had gotten pounded over the last couple of days. Energy shares up by better than 2%. Utilities also higher as well. And technology, both of which had been punished in the days after the election. Of course, bond proxies, utilities, along with those real estate companies not doing well. And the technology share is seen as suffering from a more protectionist, domestic-first policy agenda by President-elect Donald Trump.
And interesting to see those tech stocks do well after underperforming.
Tyson shares climbing as much, or I should say falling as much as 16%. Earnings missed analyst estimates. It closed off its lows, but we should mention as well that there was a change in leadership for the chicken producer. Tom Case will succeed Donnie Smith as CEO of the company.
Let's take a look at the bond market. First, a look at the 2- and 10-year yields. Not a ton of activity, continuing to inch higher on that 2-year yield. Really looks like a December rate hike is a mortal lock if markets are to believe. 10-year yields down a little bit. I want to take a quick look at the French 10-year yield. Don't talk about this a little bit. Ended up yields closing a little bit lower on the day. They were lower earlier in the day. They had the first round of the Republican primary. They're Republicans. They're a conservative party. The winner, Francois Fillon, they have the next round next weekend, but he's expected to win. He's very sort of like, they call him out of a Thatcherite mold, so a very conservative politician who would probably cut the government sector a lot. Bond markets liking a little bit, at least throughout the day at one point, that victory for him.
But it's a reminder that political risk is out there.
We'll be talking more about that.
All right, in terms of currencies, let's stay with Europe here. The theme really across currencies is the dollar takes a breather. The euro ending a 10-day losing streak in which it lost 5% of its value. You can see that move up just at the very end of the chart. And, of course, as we talk about currencies, flash crashes in FX have become much more common. The pound today saw a sudden spike in its movement. The sterling went from 124 to almost 125 in a matter of a minute. People wanted to credit that move higher to Theresa May's efforts or acknowledgement of the risks of a hard Brexit. But the interesting thing is the move came hours after she spoke.
Yeah,
so
it seems kind of implausible.
It seems implausible. Perhaps it's thin trading, lack of liquidity as the bigger driver. And it's a reminder that we're going to see more of this. And a quick mention of commodity currencies, all strengthening from a rise in the underlying prices of metals and oils. The rand is worth highlighting here because it led gains. South Africa proposed labor law reforms a few days before a credit rating review.
And finally, some interesting moves on the commodity front. Rubber rallying today. Rains thought to limit production in Thailand, so rubber had a big day. Zinc, the industrial metals, continue to gain. And crude having a huge day, rallying nearly 4%. Goldman has gone to overweight commodities for the first time in several years, so people thought maybe that was a contributor. Also, rising optimism that maybe actually OPEC will get its act together and get a deal to limit production. So crude maybe heading back towards that $50 barrel mark on West Texas Intermediate.
All right, we'll continue to monitor that one. Those are today's market minutes. Let's take a deep dive now into the Bloomberg. You can find all our charts using the function at the bottom of the screen. And I want to focus here on the dollar, specifically the trade-weighted dollar, which measures the dollar versus certain foreign currencies, the ones that are most notably used in global trade. And thanks to Hillary Clark and Alex Steele for coming up with this one. Under both Reagan and George W. Bush, so those would be the red portions of the chart, or the first part of the red portion, since George H.W. Bush succeeded Reagan. They both unleashed fiscal stimulus, Reagan and W. But the trade-weighted dollar saw a bigger rally under Reagan. The reason why? Well, it could be because the economy was in worse shape than when W started spending, and the economy was actually okay during W's term. Remember, it was looking actually a bit toppy around 2000 as well. under Bush, the trade-weighted dollar was already pretty high, so there was not a whole lot of change to be had from the stimulus. So the question is, where are we now as we get ready perhaps to unleash more fiscal stimulus? Is the economy that Trump is inheriting more like Reagan or more like W? Well,
we have a great guest who would be perfect to talk about exactly that question. With us now is Kit Jukes, Global Strategy at Societe Generale. Kit, thank you very much for joining us. I remember going into this year, everybody was talking about divergence and how this is going to be the year of the dollar, while Japan and the BOE were going to, be on hold. But it feels like maybe now that's the story for 2017, that, Europe has all these political risks out there to hold the euro back, and Japan is going to keep its long-term rates down, and that now the bull case for the dollar is very clear. Do you buy that? Does the dollar have more to go?
It has a bit more to go, but it's we might be setting up for the last hurrah. I think Scarlett hit on it, really. The U.S. economy's not got that much slack in it at this point in time. So we will get more growth. We will get faster rate hikes to a higher peak from the Fed if President Trump delivers on what people currently think they were interpreted from candidate Trump. So we'll see what we actually get. But I think we'll get a stronger dollar. I don't know if it'll be universally stronger in 2017, but maybe for the first half of the year it's a clear enough run that we can just look forward to a further spike. But at some point, stimulus is going to end up with more inflation than growth because there's not that much slack in this thing.
Right. And, of course, it all depends on where we are in the economic cycle right now. Kit, I know that we're all speculating here because we don't know the details of what a President Trump's fiscal stimulus will look like. But whose stimulus will it probably appear more like? Will it be more like Reagan, or would it be more like W, just given where we are right now?
I think the stimulus is more like Reagan's. I think it's the offset on the other side is that, remember, when we had Reagan's stimulus coming from a weaker economy, we also had Paul Volcker at the Fed. I don't think you're going to see double-digit Fed funds. That's my number one forecast for today. But, I think that's the difference. Are we going to see the kind of real interest rate moves that we saw with Reagan, as well as the really supercharged growth? I think we've got the same style of stimulus, but we haven't got as much of an economic pickup available to us because the unemployment rate's already under 5%. I think the Fed will tighten because of that, but I think the 1980s are just a dim memory in terms of how much we'll tighten. Fed funds are still really unlikely to peak above 2%. That's so much lower than it was in the 80s.
Do you think people are missing this point that you're making, which is that with unemployment rate at 4.9%, with wage growth already picking up, that essentially it's a lot easier to get inflation here than it is to get actual growth?
Well, the bond market's not missing it. Break-even inflation rates have moved significantly higher, so there's something being priced in bond land. I think in the foreign exchange market, people are going with the flow. It's been incredible how fast a consensus has developed around the idea that, yep, the Fed is going to hike in December. Yep, they'll hike, I don't know, twice, not once next year. And, yep, this is good for the dollar. Let's all buy it. These kind of moves have a tendency to overshoot. We can come back and talk about it in 6 months' time. I think it'll be a much more complicated picture.
And, of course, to Kit's point, if you look inside the Bloomberg and you look at WIRP Go, WIRP Go, right now people are looking at, using OIS, 95, 96% odds of a rate increase in December. If you move it to Fed funds, it's incredible. You're looking at 100% odds, Joe.
Yeah, Kit, to what do you explain this sudden, as you say, this incredible rush to a new consensus about Trump? A month ago, as Trump was the candidate, even 3 weeks ago or 2 weeks ago, Trump was the candidate of risk and sell-off and risk aversion. Wall Street seemed to favor Clinton for risk assets. Why did things change so fast?
I think people need, in today's parlance, they need a narrative, and they found one quickly. And there is an element of herd behavior. I think there was also an element of looking at Trump against Clinton and the whole look at some of the sort of the stories between it, the nastiness of the campaign, and focusing on what people wanted. And only when the election had happened did people turn around to some degree and say, OK, whether I like Mr. Trump or not, here's his economic plan. Geez, if he cuts taxes on corporation taxes significantly, if he cuts some income taxes, and if he embarks in some infrastructure projects, that's probably good for growth. Hey, it's probably good for share prices. And then the move started and yields started moving higher, and then it just gathers its own steam, and people
Right.
who were skeptical just shut up pretty quickly.
Well, why isn't anyone taking that to the logical conclusion, which is you've got a higher budget deficit in a higher interest rate environment? At some point, that'll be a drag on growth.
It will be, and we'll have to see where it goes. We're relatively optimistic about the first year or two or so of this, so we should get more growth. We'll have to see how much he gets through Congress. Remember, all of this will be tempered by the right-wing part of Congress. The Republicans won't give him a completely free ride, I don't think. But you're entirely right. This is going to come back. I don't think that we can have a really long economic cycle of much faster growth. If it's 2-point-something% real GDP growth for 1 or 2 years, with the Fed, say, moving up to 2% while the ECB does nothing, Bank of Japan does nothing, Bank of England does nothing, then that's probably enough to take the dollar higher more slowly from here, bond yields higher more slowly from here, and equity markets not get over freaked out by that. But it's not, I don't feel 100% confident with anything that's going on at the moment with this much uncertainty.
All right, Kit Jukes, global strategist at Societe Generale. Stay with us because next we're going to talk about a bunch of interesting stuff happening in Europe. This is Bloomberg.
Good afternoon. I'm Mark Crumpton. Let's get to First Word News. We have breaking news this hour. We are receiving reports of a magnitude 7.3 earthquake hitting about 156 miles from Tokyo, Japan. A tsunami warning has been issued. Again, the magnitude of that quake, 7.3, about 156 miles from Tokyo, and a tsunami warning has been issued. We'll, of course, continue to follow this story and bring you more developments as soon as we get them. President Obama says he intends to give Donald Trump space to lead the U.S. and set his own agenda. The president says he reserves the right to reinsert himself into the public debate if he thinks core American values are at stake. Mr. Obama spoke in Lima, Peru after a meeting of Asia-Pacific leaders. The Federal Election Commission is asking Mr. Trump's campaign to correct more than 1,000 errors in its latest financial filing. That's according to a report by CNN. The FEC concluded that Mr. Trump's campaign accepted more than $1 million in donations that violated campaign finance laws. The United Nations humanitarian chief says conditions in Syria's rebel-held Aleppo have gone, quote, from terrible to terrifying and now barely survivable, end quote. Stephen O'Brien told the UN Security Council that food is scarce, with prices getting higher and higher. Fuel and gas for cooking is reportedly unavailable in most neighborhoods. New research reveals another decline in dementia rates, but experts say rising numbers of older Americans may halt that trend unless better ways are found to keep brains healthy. The study shows the rate of Alzheimer's disease and other dementias in adults ages 65 and up dropped to about 9% in 2012 from nearly 12% in the year ended 2000. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett?
Thank you so much, Mark. Mark just mentioned the magnitude 7.3 quake that hit 156 miles from Tokyo. We've seen a move in the Japanese currency, the yen right now, if you come inside the Bloomberg terminal, strengthening, so erasing its losses, and we're now at 110.52. So the yen fell below 111, now at 110.51, and I should say strengthening even more as we continue to go. So here, this is the dollar dropping in value versus the Japanese
against
yen.
the yen. Yeah, I remember in the 2011 earthquake, of course, there were a lot of companies repatriating cash from overseas, causing the yen to strengthen as part of the rebuilding efforts, insurance, so perhaps some of the anticipation of that. All right, what do you miss? Investors see the euro, not Italian bonds, as one way to express concern that Prime Minister Matteo Renzi's reforms will become the latest victim of a rising populist mood. Let's take a deep dive into the Bloomberg. You can find these charts using the function at the bottom of your screen. You can see that the euro has fallen more than Italian sovereign bonds in recent days, perhaps on concerns about upcoming political risk in Italy and elsewhere. We're back with Kit Jukes, global strategist at Societe Generale. Kit, lots of political risk coming up in Europe in the weeks and months and years ahead. Obviously, Italian referendum. On December 4th, we get the Italian referendum and a rerun of the Austrian presidential election. Would you say that investors are adequately hedged against what's coming up in Europe, or could they be blindsided by further developments?
I think the Italian referendum only blindsides people now if Matteo Renzi resigns on a no vote. So opinion polls have been overwhelmingly in favour of a no vote. We're now in a blackout period. But so I guess the betting agencies who've struggled for the last few elections are going to conclude this is likely to be a no. But it's equally unlikely that Mr. Renzi resigns. He's got an election due in 2018. He doesn't have to do anything. This was a referendum about constitutional reform, so it doesn't automatically trigger a response. So I think the market is positioning itself for a bad headline and then some uncertainty, but not much else happening if the guy in charge just simply says, oh, well, I lost, and carries on.
Well, he had said at one point that he would resign if he lost, but he was trying to backpedal that as well. Kit, the ECB's next meeting comes about 4 days after the Italian referendum. Does that meeting rest entirely on what happens to the referendum?
Not quite, but I think they'll want to do everything they can not to rock the boat. So Mr. Draghi will do whatever it takes to stabilise markets and to keep things under control. And whatever it takes probably does mean some form of stretching out their bond buying. The last thing you'd need in today's volatility, and if we have any more volatility at the beginning of December, the last thing you need is the European Central Bank saying, all right, we're done buying bonds soon, we're going to stop in March. They'll have to do something to stretch that out just to calm sentiment down. I think that's one of the things that's changed over the last few weeks, since the US election, that Mario Draghi wins that argument within the ECB Council at this point.
Kit, let's talk about France. We obviously had the first round of the Republican primary this past Sunday. The winner, Francois Fillon, is seen as a Thatcherite, not a populist at all. Some concern that maybe he has some weakness on the left flank to Le Pen victory. Overall, the consensus seems to be she probably can't win, but we really don't want to say that after we keep getting egg on our faces about all these elections. How do you handicap what's coming up ahead?
Well, I think the market, look, my bet in market terms would be that the euro hits its low right up close to the election, possibly on the day of the election. I don't know if we're going to be confident unless we get some overwhelming opinion polls at this point. Possibly the same for some of these peripheral bond spreads, for the spread between French bonds and German government bonds by the same token. That, you know, this could be a straight fight between right and left in the sense that you've got a pro-state, so big state, populist nationalist party candidate against a right-wing, smaller state, a more conventional right-wing economics candidate. So a direct opposition. But you also have the danger that in the first round we get possibly someone from the Socialist Party, but then, you know, two rogue elements coming through. So we could have 5 candidates in total quite easily, with Marine Le Pen from the National Front holding the biggest single vote in the first round, going through while we all assume she then comes second. Right. My assumption and confidence is going to need a drink the day before that second vote.
You know, back in, I think it was 2002 when Marine Le Pen's father, Jean-Marie, won, the left came and united around the conservative challenger, and Jean-Marie Le Pen lost convincingly. Do you think there's a risk that that won't happen as cleanly this time around?
I think, well, it depends how we define cleanly. I think there's a danger that it's not as clean as it was then, because that's where this populist movement comes. And that's where if the main opposition, for a lot of voters, if the main opposition is someone who is, you know, keen on a small state, more conventionally conservative in the Anglo-Saxon sense of the word on the economy, that there's a lot of people to the left who, in a country with a history of big government and a big public sector, there's a lot of people who are going to be very uncomfortable with that. So it's going to be tricky to generate that whole groundswell of we've all got to unite against the National Front.
All right, Kit Jukes, global strategist at Societe Generale. Thanks for joining us. Always great to get your perspective.
Coming up, the Hewlett-Packard brand is focusing on its faster-growing enterprise IT unit after the spinoff. We'll look at the details behind the company's financial performance, and the numbers don't lie. This is Bloomberg. Scarlet Fu. What'd you miss? Both HP Inc. and Hewlett-Packard Enterprise report quarterly earnings after Tuesday's U.S. closing bell. The businesses split into two separate companies more than a year ago. CEO Meg Whitman leads HP Enterprise, which is the focus of today's The Numbers Don't Lie. So let's start with a look at HPE's revenue breakdown. Its enterprise group, which includes server, storage, and networking, makes up 51% of sales, so that orange slice of the pie. The enterprise services segment, which will be spun out and merged with CSC, is 37%, the purple slice. Software, meantime, will be merged with Micro Focus. And when it comes to the bottom line, Hewlett-Packard Enterprise is cutting costs and restructuring to increase its earnings growth. It does face macroeconomic challenges, as well as tighter corporate budgets and threats from the public cloud. Hewlett-Packard Enterprise's cloud offerings are likely targeted at private clouds. That's the yellow section in these bars, the middle yellow section. It's a growing segment within the confines of traditional IT infrastructure. Private cloud spending may reach $20 billion by 2019 as traditional IT spending declines. The hybrid cloud model, meantime, uses a mix of private and public cloud services. HPE projects that this will become a $100 billion market, growing at 1.5% annually. Still, HPE's long-term operating margin target of 7% to 9% may be driven by improved cost structures rather than sales gains. The service segment spin-off could accelerate the timing and the magnitude of that margin expansion. Now, the split of HPE has really paid off for shareholders. Hewlett-Packard Enterprise, which is the orange line at the top there, and HP Inc. is the blue line over there, are both beating the S&P 500, the white line, over the past 12 months. Hewlett-Packard Enterprise's overall strategy is to be a small, nimble company that's focused on hybrid cloud technologies, mobility, as well as the Internet of Things and services. Meantime, HP Inc., of course, is the hardware company, which is the legacy printer and PC business. We'll be tracking both companies' earnings when they're released Tuesday after the U.S. closing bell. Joe?
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Mylan is rejecting U.S. Senators' request to testify later this month at a congressional hearing on the price of its allergy shot EpiPen. Senate Judiciary Chairman Charles Grassley of Iowa has scheduled a November 30th session to examine how the drug maker gave Medicaid smaller than legally required discounts on EpiPen, potentially denying the government millions of dollars. Tesla Motors says it has completed its acquisition of Solar City, a purchase intended to help Chairman Elon Musk fulfill his vision for a viable one-stop shop for clean energy consumers. The deal, valued at about $2 billion, integrates the maker of Model S and the upcoming Model 3 sedans with the installer of rooftop solar panels. And Carrefour has tapped Morgan Stanley and Societe Generale to advise on an IPO of its shopping mall property unit, Carmila. That's according to people familiar with the matter. Carmila could sell shares in Paris next year, though no final decisions have been made. The unit could be worth about $4.8 billion. That's the Bloomberg Business Flash.
Coming up next, we speak with Tampa Bay Lightning chairman and governor, Jeff Vinik, owner, I should say, the latest on why his and Bill Gates' investment companies are investing billions of dollars into building up the city of Tampa, Florida. This is Bloomberg.
I'm Mark Crumpton. It's time now for First Word News. Former Massachusetts Senator Scott Brown says leading the Department of Veterans Affairs is the toughest job in the cabinet. Brown indicated he is under consideration to lead the embattled agency following a meeting with President-elect Donald Trump. Mr. Trump also met with Oklahoma Governor Mary Fallin. She says she has not been offered a post in the administration. Hillary Clinton lost the race for the White House, but a new poll finds voters preferred her campaign to that of Mr. Trump. Just 30% of those questioned in a new Pew survey gave Mr. Trump an A or B grade for his campaign. 35% gave him an F. Meanwhile, 43% gave Secretary Clinton an A or B. That's the first time in the history of Pew's post-election poll that the losing candidate earned better grades than the winner. The Associated Press, citing a U.S. monitoring service that tracks militant postings, reports that an Islamic State affiliate has claimed responsibility for today's suicide bombing inside a Shiite mosque in Afghanistan. That blast in Kabul killed at least 32 people. Dozens more were wounded. It was the second large-scale attack targeting minority Shiites in the Afghan capital in just over a month. Japanese peacekeepers have arrived in South Sudan with expanded powers. For the first time since the end of World War II, the soldiers will be allowed to use force to protect civilians. Japan's post-war constitution forbids the use of force in settling international disputes, but the government issued a new interpretation. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett?
Thank you so much, Mark. And we want to recap breaking news from earlier. An earthquake with a preliminary magnitude of 7.3 has struck off the coast of Fukushima Prefecture in Japan. It's about 156 miles away from Tokyo. A tsunami warning for waves of up to 3 meters, that's about 10 feet, has been issued. And, of course, it's reminders to what had happened in March of 2011. Joe and I were talking about how the yen strengthened on the headline that broke. And if you come inside the Bloomberg, that was certainly the case. But we've now seen the yen come back a little bit here. And so dollar is little change now versus the yen at 110.85. But we did see dollar yen break below 111 to as low as 110.45.
All right, we'll be watching that. Let's also get a recap of the rest of today's market action. Green across the board, record highs on all the major indices. You can see there record highs everywhere you look. NASDAQ up 0.89%. That was the big gainer. Tech leading the way. Within the S&P 500, the one category that didn't do well, that was actually in the red slightly, was real estate. So some of these yield, bond proxy, safety areas that were so popular up until very recently continue to underperform since the election.
Joining us for more on today's record-breaking market action is Tampa Bay Lightning Chairman and Governor Jeff Vinik. And, of course, before purchasing the NHL team, Jeff was CEO of Vinik Asset Management. He was also the former manager of Fidelity Investments' flagship Magellan Fund, which had an average annual return of 18% and $55 billion in assets under management. Jeff, great to see you.
I'm happy to be here. Thank you.
So I'm going to ask you to put on your hat from your previous life for a moment here and give us your thoughts on this environment after the election. We seem to be in a situation where investors are giving the incoming president all the benefit of the doubt and pricing in all kinds of good things for the economy. What do you think of what we're seeing right now?
Well, I'm happy to be here on a day where all the indices are hitting new highs. That's pretty exciting. But I think one of the things going into the election, there was a great deal of uncertainty, a good deal of pessimism going in. I think there would have been a rally, frankly, no matter which candidate had won, as the uncertainty gets lifted. And clearly, there's been, it's interesting because obviously it wasn't expected that President-elect Trump was going to win. So you've had a major dislocation in the market. In fact, in the days following the election, it seemed like half the stocks were up 20-30%, half the stocks were down. Really a very interesting time. I think big picture, we have decent economic growth, we have low inflation. Yeah, it may pick up a little bit, but it seems like a good backdrop for stocks and a good backdrop for the economy.
Just from a pure business perspective, putting aside the market for a moment, if one looks at Trump's rhetoric during the campaign and what we found afterwards, there's stuff that one probably liked from a business perspective: lower taxes, regulatory rollback, more spending on infrastructure. There are also things in there that most business people probably wouldn't like, such as some of his talk about trade, immigration, both unskilled and skilled immigration. That being said, mostly people seem to be focusing on the good so far, and ignoring like the fact that we still might get sort of a more populist attitude on trade and some other things. Why do you think that is?
I mean, I think big picture-wise, if you look at Trump's economic policies or what he's going to try to put into place, it's pro-growth. And, yeah, there are positives, negatives, as you talked about some of the components. But clearly we're looking at an environment coming up that probably should lead to somewhat faster economic growth, good for profits, good for wages, good for jobs. Seems like a pretty good environment.
And, of course, one of the things that he's been touting is the infrastructure spending. He kind of envisions it, or a lot of people speculate that what he has in mind is a private-public partnership. There are pitfalls associated with that. What do you think we need to watch out for as investors come to terms of with what's ahead and how businesses position themselves as well?
Yeah, I mean, you talk about public-private partnerships and infrastructure. That's on our minds a lot in Florida and in the Tampa Bay area. We are hoping to make some big investments in infrastructure in the years ahead, and I could see perhaps it comes from some spending, government spending that's thrown off from an infrastructure bill. Perhaps it's a public-private partnership, et cetera. But I think overall we're going to be in a reasonably good environment where businesses can have confidence to make investments.
How do you see the labor situation? Because one argument against the idea of a big infrastructure boom is that the labor market's gotten tighter. If you look at surveys of businesses, more and more they say they have difficulty hiring workers as it is. You imagine that if there were some big new projects, that would be a further strain on the labor market. From your perspective, how much spare capacity is there in the labor market?
You know, there's some, but there's not a huge amount, but I think that's only part of the picture. I do think we are in the beginning stages of labor inflation, of wage inflation, due to tightness in various areas. I think it'll be gradual as some people come back into the labor force. But contrary to other people, I think it's going to move very slowly into consumer prices overall. So you could have a long period of time where actually the average worker is doing a little bit better. And, you know, after years of real wages going down for the average worker, they could see some benefit over the next several years. I'm hoping that we're in a better trend there.
And you and Bill Gates' Cascade Fund are investing a lot in Tampa Bay, Florida. That's your new project. That's your passion. Part of this is to develop the city into an economic success story, encourage entrepreneurship. One thing you've pointed out, though, as a weakness for Tampa Bay is wages and perhaps the labor market there. Talk to us about what you're doing to get Tampa Bay up to speed.
Yeah, if you look at, you know, I've been in the Tampa Bay area now for 6-7 years since buying the Tampa Bay Lightning. It's actually a great opportunity. The economy is doing extremely well there. Job growth is right now over 3.5%. Population's increasing 2%. You actually have nominal economic growth there between 5 and 7% right now. So it's a very strong area. One of the reasons I bought the team, one of the reasons, along with Bill Gates and Cascade Investment, we're doing a $3 billion mixed-use development is because we see this. The whole Tampa Bay-Orlando corridor is one of the best areas for growth over the next 10 to 20 years.
Why is that? I mean, I was thinking, I remember during the crisis, and a lot of people were saying, oh, Florida's toast, but it's like people are just going to keep moving to Florida forever.
Well, people are moving to Florida. Businesses are moving to Florida. And importantly, after decades of depending on housing, the Florida economy is diversifying. As was just discussed, we in Tampa Bay are going to be putting a great emphasis on higher wages jobs, on creating an innovation ecosystem, entrepreneurialism, to bring young companies to Tampa, to keep the best and the brightest.
Specifically, what areas outside of real estate are you seeing the most growth?
Business services. And the Tampa Bay area has led the Florida in growth and job growth 3 of the last 6 years, led by business services and professional services. I think if we look at areas for innovation, what comes to mind in our region is financial services, life sciences, tourism, and perhaps sports.
What about the demographics? You have proximity to Latin America, but you also have an older population, an older community, and it's kind of a microcosm of a lot of what the U.S. is looking at right now. How do you reconcile that with some of the protectionist talk that we're getting from President-elect Donald Trump?
Yeah, Latin America is close. It's especially, obviously, for Miami and Florida. It's a major area of focus. Again, the Tampa Bay area economy is very diversified. Trade with Latin America is a small part of it. There are areas that'll benefit. There are probably some areas that'll get hurt a little bit. But I do want to say one thing. Actually, contrary to most people's belief, Tampa, Florida, the average age, the median age there is actually less than the national average.
Oh,
it's only
really?
37 years old. Tampa, Tampa, Florida is, I believe, going to become a business hub of the whole southeast United States.
It's all those hockey players. All right, Jeff Vinik, you're sticking with us. We're going to talk about the financial turnaround of Jeff Vinik's Tampa Bay Lightning and what that means to the NHL. This is Bloomberg. I'm Scarlett Fu. What'd you miss? The Tampa Bay Lightning Hockey Club are skating on a path towards profitability. The team was on the brink of insolvency when Jeff Vinik bought it back in 2010. Jeff Vinik is here with us today in New York. So when you bought in 2010, they were financially troubled. You had said that the team is almost out of the red, on the verge or roughly break even. Yes. Give us an update now. Where does it stand?
Yeah, we are roughly break even.
Roughly break even. Can you give us a more specific sense of when you'll get to a meaningful profit?
I think that's a pretty good sense. When I bought the team, which again, as you know, was 6-7 years ago, our goal was to be world-class on and off the ice, but I had three main objectives that were related to that. One was to be one of the best teams in hockey year in and year out, and I think we're achieving that. Two was to have a big impact on the community and be able to inspire others and be good leaders in the community. We think we're doing a good job with that. And three was to get to roughly break even financially, and we're achieving that. So we're very happy where we're at right now.
So you're a Sunbelt hockey success story. Sunbelt hockey teams have not necessarily all done well. I think of the Coyotes, for instance. What are you doing differently?
I think, frankly, the National Hockey League's in a great spot right now, and many of the teams are thriving throughout. We went there, and I was very fortunate. First thing I did after we tried to be world-class, or said we were going to be world-class, I was able to hire Todd Leiweke as CEO of the Lightning. I was able to hire Steve Yzerman as general manager of the Lightning. And third of all, with those guys there, I didn't meddle in their business. I just brought two people who are some of the best in the business of sports. Let them do their craft, hold them accountable, give them resources, hold them accountable. But I didn't meddle too much, and I think that's part of the formula here for having success.
Talent. Basically talent. Okay. So speaking of talent, one thing that everyone's up in arms over is whether the NHL will allow its players to play in the Olympics the next go-round. Where do you stand on that? Because it feels like that's taking center stage and maybe proving to be a bit of a distraction.
Yeah, the Olympics are obviously a great event. Hockey's been the hallmark. If you look at the Winter Olympics over the last several cycles, hockey has been the #1 event there. Our players like going there. The owners have mixed feelings, to be perfectly honest. But for us to go to the Olympics, we have to be taken care of properly, and I think that's something that I'll leave up to the commissioner. He'll do a great job with that.
Can you be more specific with being taken care of properly?
Well, there are insurance payments that are need to guarantee player contracts, things like that, and we have to make sure that we feel confident if we were to go to the Olympics, if we think it's the right decision, that we're not losing money while that's going on. That wouldn't make a lot of sense. We are donating our assets, taking the risk of injury. We should be compensated in return.
Some people would argue that that was the case with the World Cup of Hockey as well in September, that you were taking the risk of injury too. That went off without a hitch, and it was a fantastic tournament. I wonder to what extent that removes the need to have to go to the Olympics. Do you see a connection there?
Well, you know, they're both great events. The World Cup of Hockey, it was very exciting. The U.S. Canada under 23 team was very exciting. The quality of hockey was very exciting. It was great to get our fans involved 2-3 weeks earlier in the year. So, you know, in terms of a showcase for the sport, both the World Cup of Hockey, the Olympics, both are great demonstrations of our talent and the quality of our athletes.
So I was in Vegas this past weekend. Full disclosure, my husband put some money down on the Rangers, which have 8-1 odds to go all the way in June. But we also looked at how Vegas bookies have your Lightning at 5-1.
Wow.
What do you think of those odds?
Well, I hope we're 1-1. I hope we win the whole thing. That's what I'm looking forward to. You know what's amazing about hockey, though, which is one of the reasons why it's the greatest sport, is that it's so competitive. It's so even across all the teams. In other sports, you know, some teams are really dominant and have a high probability of winning. In the NHL right now, I could give you 10 teams, each who has a legitimate shot of winning the Stanley Cup. I would say the Rangers are one, and I like to think the Lightning are another.
Well, the Vegas bookies certainly think so. But speaking of Vegas, do you have any concerns about the expansion of the NHL to Las Vegas with gambling? Because people wonder if that will infiltrate the game or at least meddle in the game in some way.
No, I don't worry about that at all. I think Las Vegas is going to be a great market for the NHL. I think the team's going to be very successful, strong ownership, strong demographics, etc. We'll have great fan support there, so I think it's going to be very successful there. We can keep the gambling separate. It's not going to get involved with our game.
All right, Jeff Vinik, Chairman and Governor of the NHL's Tampa Bay Lightning. Thank you so much.
Very welcome.
Joe?
Thanks, Scarlett. We want to reiterate some breaking news. Japanese broadcaster NHK now saying that a tsunami is imminent as seen off Fukushima's Iwaki City. That's after an earthquake with a preliminary magnitude of 7.3. There's a tsunami warning for waves up to 3 meters. That's 10 feet. Also have a headline. Tohoku Electric says no abnormality reported at an Onagawa plant. That's also via NHK. We'll bring you more headlines. We have a live report up next. This is Bloomberg. Japan's weather agency issued a warning for a possible 3-meter tsunami on the coast of Fukushima, home to the nuclear power plant destroyed by a March 2011 earthquake. Advisories for tsunami levels of 1 meter issued for other portions of Japan's northeast coast. Bloomberg's Rosalind Chen joins us now on the phone from Hong Kong. Rosalind, what are the key details that we know as of this moment?
So right now we know it's a magnitude 7.3 quake, which hit Fukushima, and a tsunami warning was issued. The tsunami warning detected up at Iwaki in Fukushima. Of course, as you mentioned, Fukushima was where that huge quake hit back in 2011, and we've had reports already that various power companies there are checking their facilities. TEPCO, for example, the Tokyo Electric Power Company, is checking its facility there to make sure things are okay. Of course, we don't know exactly when, if a tsunami will hit, although, of course, this warning has been issued. And this 7.3 quake does follow a few other slightly smaller quakes, which have happened this morning in the last hour or two. So far, we've had a report from Tokai Daini nuclear plant, according to NHK, saying that there's been so far no abnormalities reported there. TEPCO has been checking its facilities as well to make sure things are okay there. Of course, there were concerns back in 2011 about the nuclear power plants that were being used in Japan at that time.
And, of course, some other headlines here, Rosalind, as I'm looking at the Bloomberg. According to NHK, a fire has been reported at Fukushima's Iwaki city after the quake, and a tsunami also detected at Iwaki in Japan's Fukushima. We saw an immediate reaction in the yen in that it strengthened. It erased its losses following the headlines. Based on what had happened in the past, what do you think trading will look like as investors and traders come in on Tuesday morning?
This quake hit 156 miles from Tokyo, so we don't know yet. We haven't had reports yet of how this might affect the capital and whether it's going to be big enough, for example, to affect trading, whether any buildings have been affected in the capital. So at this point, it's going to be difficult to say. Of course, it's going to be a bit of a nervy day, I think, for many people, unless this dies down. At the moment, it's about nearly 6 o'clock, nearly 7 o'clock now in Tokyo. So the markets will open in a couple of hours.
Right. Another headline that just crossed as well, a 5.4 magnitude earthquake near the east coast of Honshu, Japan. So as Rosalind was telling us, the danger here as well is follow-up earthquakes or the tremors afterwards.
And you can see dollar yen if you want to go into the Bloomberg diving in the immediate aftermath of these headlines. That represents a yen strengthening. Then but the currencies bounce back a bit, but still a little bit stronger on the evening.
All right, Bloomberg's Rosalind Chen, thank you so much for keeping us up to date on this. And, of course, we'll give you any other headlines that cross on the Japanese earthquake. Coming up next, President-elect Donald Trump vetting more finance kings for the top Treasury job. We'll look at who the contenders are. This is Bloomberg.
What do you miss? President-elect Donald Trump resumed meetings today in New York with potential hires for his administration. He met over the weekend with Vice President-elect Mike Pence and at least 3 candidates for Treasury Secretary, all of whom have connections to Wall Street. Joining me now from Washington, D.C. with more is Bloomberg News White House editor Alex Wayne. Alex, thank you very much for joining us. So 3 names, all associated with Wall Street. Are there any hints of the populist side of Trump coming out in how he's thinking about Treasury?
No, we haven't heard about anybody from Main Street going up to New York City to meet with Donald Trump. He's looking really at financiers from Wall Street for this job, the Treasury post.
Is that a problem or anything? Like, why is that not a hit to his image? I mean, he hammered Hillary Clinton over his ties to Wall Street. A lot of his criticism was of the elites on Wall Street. So why is that not a problem for him politically if he hires someone who's sort of a mainstream Wall Street financier for this post?
Quite frankly, I think he's getting a lot of leash from his supporters right now. He's not looking at anybody for any of his cabinet posts, really, that strike me as much outside of the mainstream. I mean, guys like Mitt Romney for Secretary of State don't seem to be the type of character that many Donald Trump voters expected to see in the government.
Yeah, I think last week when you were on the show, Alex, you said that if Trump offered Romney the Secretary of State role, that you would eat your hat or give us money or something like that.
I'll give you $1.
You stand by that now?
And same for some of the people he's looking at for Treasury. For instance, one guy he's looking at is Jonathan Gray, who heads real estate at the Blackstone Group. He's a Democrat. He's a big Democratic Party donor. He maxed out to Hillary Clinton in this cycle. I'll give you another $1 if he appoints Jonathan Gray to Treasury. But I'm also wrong a lot, so it could very well wind up that both of these guys end up with jobs in the administration.
Ultimately, if they do, I mean, he hasn't picked one yet, but if one of these guys does get hired or does get offered this position of Treasury, it would seem like that would go a long way towards telling Wall Street they don't have that much to be nervous about, would probably really remove one source of major uncertainty and anxiety about this administration.
I feel like the markets are already telling us that Wall Street isn't too worried about this administration. And it's not like Donald Trump ran on strengthening Dodd-Frank or anything like that. He ran on the opposite. He's here to make rich guys richer. Is his campaign theme. All
right, Alex Wayne, Bloomberg News White House editor. Thank you very much.
Sure.
And before we go, we just want to mention again that a magnitude 7.3 earthquake struck Japan off the coast of Fukushima, which is home to the nuclear power plant badly damaged back in the quake in March of 2011. You're looking there at state-run broadcaster NHK. It had said a tsunami was expected imminently at Iwaki City. NHK also saying a tsunami measured at 60 centimeters measured in Onahama. We will keep you posted on this breaking news. This is Bloomberg.
Respect to Donald Trump, he may be having a bit of a honeymoon, but it's still the case that not everyone wants to shake your hand. There has been a magnitude 6.9 earthquake off the coast of Fukushima in Japan, causing a tsunami warning. We'll be monitoring that throughout the show and report with any updates. Meanwhile, there continues to be a lot of interest in potential conflicts of interest when it comes to Donald Trump's sprawling business empire. So far, the president-elect has done next to nothing to assuage those concerns, and in fact, in some respects has only exacerbated them. Democrats are howling over an Argentina newspaper report that says that Trump used his congratulatory phone call with the Argentinian president, Mauricio Macri, to ask for help with a stalled construction project that will bear his branding in Buenos Aires. A spokesman for Macri denies that that ever happened, but it's hardly the first accusation that Trump might use his new power to boost his family's bottom line. Last week, in between administration job interviews, Trump met with 3 Indian commercial partners who are building a luxury Trump office building south of Mumbai and, according to reports, seem eager to capitalize on their newly valuable connections to the president in waiting. The Washington Post reported that 100 foreign diplomats attended a sales pitch about the Trump International Hotel in Washington last week, and some of them consider the opportunity to spend bigly at the hotel an easy way to flatter the incoming POTUS. Separately, a Washington Post analysis of Trump's business dealings found that at least 111 Trump-related companies have done or are doing business in 18 countries across South America, Asia, and the Middle East. None of what Trump has done to this point appears to be illegal, but it certainly raises suspicions that he could, if he wanted to, profit financially from his occupancy in the highest office in the land. If only someone had told the president-elect that he might want to be a little more careful about the appearance of conflicts of interest.
Obviously, my assets were significantly smaller than some other presidents or president-elects, but we made a decision to liquidate assets that might raise